Good morning. Welcome to your daily morning digest for Saturday, February 7th, 2026. I'm your host, and we've got a power-packed show for you today. Grab your coffee, settle in for the drive, and let's dive into what's moving markets, shaking up the crypto world, and reshaping the tech landscape. The Dow hits 50,000, a historic milestone. Let's start with the headline that made history yesterday. The Dow Jones Industrial Average closed above 50,000 for the very first time. After 3 brutal days of selling pressure that had investors on edge, Friday delivered a massive relief rally. The S&P 500 surged 2%, clawing its way back into positive territory for 2026. The Nasdaq, which had been bleeding red from tech stock weakness, finally found its footing. What drove this turnaround? 2 names tell the story: NVIDIA and Caterpillar. NVIDIA, the AI darling that's become synonymous with the artificial intelligence boom, rocketed nearly 8% higher. Caterpillar, the construction equipment giant, surged 7%. These gains weren't just numbers on a screen. They represent a broader shift in sentiment. Investors who had been fleeing to safety suddenly found their appetite for risk again. But here's the kicker. Even with Friday's monster rally, the S&P 500 still finished the week down 0.1%. And the Nasdaq dropped 1.8% for the week. We're seeing classic volatility, wild swings that reflect deep uncertainty about what comes next. The fact that we needed such a massive single-day move just to get back to break-even for the year tells you everything about how fragile this market really is. Bitcoin's brutal reality check. Now let's talk about the elephant in the room, or should I say, the Bitcoin in the basement. The world's largest cryptocurrency is trading below $67,000 as of yesterday, which puts it lower than it was when President Trump won the election back in November 2024. Let that sink in. Trump, the self-proclaimed crypto president, campaigned on making America the crypto capital of the world. He promised favorable regulations, strategic Bitcoin reserves, and a golden age for digital assets. Instead, Bitcoin has lost more than half its value from its October peak. The price action tells a story of broken promises and harsh reality. On Friday, we saw a brief bounce back above $70,000, but the damage is done. Investors pulled $5.7 billion out of spot Bitcoin ETFs from November through January. That's not profit-taking, folks. Why the collapse? It's a perfect storm. First, there's the flight from speculative assets as the macro environment gets shakier. When uncertainty rises, investors dump the most volatile holdings first, and crypto tops that list. Second, despite Trump's rhetoric, meaningful crypto regulation remains stalled in the Senate. Democrats are demanding ethics provisions that would stop the president from profiting off his own crypto holdings, and that groundswell of opposition is growing. Third, and perhaps most damaging, is Trump's own tariff chaos. The president has threatened Canada, South Korea, and 8 European countries with new tariffs, using trade policy as a blunt instrument for foreign policy goals. Markets hate uncertainty, and crypto, which thrives on narrative and momentum, hates it even more. Augustine Fan, a partner at Hong Kong-based crypto platform Signal Plus, summed it up perfectly. Crypto sentiment is hitting rock bottom. Volatility has finally moved up after a year-long move lower as traders scrambled for protection, with markets trading in bear market mode. Are we entering a new crypto winter? It's starting to feel that way. The narrative that drove Bitcoin to 6 figures has cracked. Retail traders are staying away. Institutional money is flowing out. And the regulatory clarity everyone hoped for, still nowhere in sight. The DeepSeek disruption continues. While American tech giants scramble to justify their massive AI spending, a Chinese upstart continues to rewrite the rules. DeepSeek, the AI lab founded by hedge fund manager Liang Wenfeng, is preparing to launch its V4 model later this month, likely around the Lunar New Year between February 12th and 14th. Here's why this matters. DeepSeek's R1 model proved you don't need billions of dollars to compete with OpenAI, Google, and Microsoft. The company claims it matched the reasoning capabilities of OpenAI's top-tier models for just $6 million in computing costs. $6 million. When the incumbents are spending tens of billions, that's not just disruptive, it's existential. DeepSeek has also done something the American companies won't. They've open-sourced their research. They extended their original 20-page paper to a detailed 80-page technical document that lays out their entire framework. While OpenAI operates in secrecy and Google guards its models like state secrets, DeepSeek is saying, here's how we did it. Go build on it. The implications are massive. If DeepSeek is right, If efficiency matters more than brute force compute, then the entire AI investment thesis needs to be rewritten. Which brings us to our next story. Alphabet's AI spending shock. Speaking of AI spending, Alphabet, Google's parent company, just gave investors a reality check that sent the stock tumbling 5% on Thursday. The company announced it expects to spend between $175 billion and $185 billion on AI infrastructure in 2026. That's roughly double what they spent in 2025. Wall Street's reaction? Panic. Analysts had already penciled in big numbers, but this blew past even the most aggressive estimates. The concern isn't whether Google needs to invest in AI. Of course they do. The concern is whether these investments will ever generate returns that justify the cost. Think about it. If DeepSeek can build competitive models for $6 million, why should investors applaud Google spending hundreds of billions? The efficiency gap is starting to look like an existential crisis. Google is betting that scale and compute power will eventually create an unbeatable moat. DeepSeek is betting that smart engineering and efficient architectures win. Right now, the market is starting to question which bet is right. This tension isn't going away. In fact, it's the defining question of the AI boom. Is this a race to build the biggest data centers, or a race to build the smartest algorithms? Your answer to that question will determine whether you think NVIDIA at current prices is a steal or a bubble. Amazon's post-earnings slump. Not everyone had a good Friday. Amazon, the e-commerce and cloud computing giant, sank more than 5.5% to lead Dow decliners after disappointing quarterly results. The details matter here. Amazon's revenue growth is slowing, its e-commerce margins are compressing, and most importantly, its AWS cloud business, the cash cow that funds everything else, is facing stiffer competition. This is the other side of the AI story. While everyone focuses on the training models and frontier research, the infrastructure providers like Amazon Web Services are caught in a squeeze. Customers want more for less. Competition from Microsoft Azure and Google Cloud is intensifying, and the capital expenditures required to stay competitive keep climbing. Amazon's decline is a reminder that even the mega-cap tech giants aren't immune to gravity. When your stock has run up on AI hype, you'd better deliver AI revenue. And if the revenue disappoints, the market doesn't wait around for explanations. The jobs picture gets murkier. Let's shift to the broader economy. The Federal Reserve is now describing the U.S. labor market as a low-hire, low-fire environment. That's Fed speak for stable but stagnant. Job growth is moderating. The unemployment rate has drifted slightly higher, and jobless claims jumped by 22,000 last week to 231,000, the highest in 2 months. Here's the kicker. The January jobs report, which was supposed to be released yesterday, has been delayed due to another government shutdown. Yes, another shutdown. That means investors, policymakers, and businesses are flying blind on one of the most important economic indicators. What we do know isn't encouraging. Manufacturing employment dropped 68,000 jobs in 2025. Factory production contracted at a 0.7% annualized rate in the fourth quarter. The housing sector remains weak, with starts and permits falling in recent months. And according to a Federal Reserve analysis from Kansas City, Trump's tariffs may be costing the U.S. economy thousands of jobs monthly. The tariff issue is particularly insidious. Tariffs can theoretically increase or decrease labor demand, but they're being implemented alongside other major workforce disruptions: the rise of artificial intelligence, an aging population, and reduced immigration. The combined effect is a labor market that's lost its dynamism. We're not hiring aggressively, but we're not firing aggressively either. We're just stuck. The Fed, which cut rates 3 times at the end of last year to support the labor market, has now hit pause. Last week, they kept the benchmark rate unchanged, citing a broadly improving economic outlook and a stabilizing labor market. Translation: we're not confident enough to cut rates, but we're not worried enough to hike them either. It's monetary policy paralysis driven by economic uncertainty. What it all means. So what's the big picture here? We're in a moment of profound transition. The old certainties are cracking. Bitcoin was supposed to be digital gold. Instead, it's proving to be digital risk-on. The AI boom was supposed to reward the companies with the biggest budgets. Instead, we're learning that efficiency might matter more than scale. The labor market was supposed to stay strong. Instead, we're seeing a slow grind towards stagnation. Markets hate uncertainty, and right now, uncertainty is the only thing in abundant supply. Trump's tariff threats, government shutdowns that delay critical economic data, AI spending that may or may not pay off, crypto promises that may or may not materialize. Friday's rally to Dow 50,000 was real, and it mattered. But it was also fragile, built on two stocks and a surge of short covering rather than fundamental optimism. The fact that Bitcoin bounced back above $70,000 on Friday, only to remain near year-long lows, tells you everything about investor sentiment. We want to believe, but we're not quite ready to commit. The weeks ahead will be crucial. We have the delayed January jobs report coming whenever the government reopens. We have the 4Q25 GDP estimate dropping on February 20th. We have DeepSeek's V4 launch mid-month, which could further shake up the AI narrative. And we have ongoing uncertainty about Trump's trade policy, regulatory agenda, and economic priorities. In times like these, the best strategy is the hardest one. Stay informed, stay flexible, and don't let emotion drive your decisions. The market is giving us plenty of reasons to panic and plenty of reasons to celebrate. The key is distinguishing signal from noise. And now, let's shift gears to today's life wisdom segment, the power of water, a timeless lesson from Lao Tzu. Today's wisdom comes from one of the most profound philosophical traditions in human history, Taoism, and specifically from Lao Tzu's Tao Te Ching. The lesson? The power of water. Lao Tzu wrote, "Nothing in the world is softer and weaker than water. Yet for attacking the hard and strong, nothing surpasses it. There is nothing like it." Think about that for a moment. Water is formless. It has no structure of its own. You can pass your hand through it effortlessly. A child can splash it around. And yet, over time, water carves through solid rock. It shapes mountains. It creates canyons. The Grand Canyon, one of the most spectacular geological formations on Earth, was carved by water flowing persistently over millions of years. How does something so soft defeat something so hard? Through two qualities that seem almost contradictory: flexibility and persistence. Flexibility, the art of adaptation. Water doesn't fight. It doesn't resist. It simply flows around obstacles. Pour water into a cup, and it becomes the shape of the cup. Pour it onto the ground, and it finds the path of least resistance. Block its path with a rock, and it flows around the rock. The rock doesn't move, but the water keeps going. This is the first lesson. Flexibility is not weakness. It's strategic intelligence. In markets, we see this principle play out constantly. The traders who survive aren't the ones who stubbornly cling to a thesis when the facts change. They're the ones who adapt. When Bitcoin was at $100,000, the narrative was digital gold, institutional adoption, unstoppable momentum. When it fell to $67,000, the narrative shifted to bear market, regulatory uncertainty, wait for the next cycle. The facts changed. The flexible traders changed with them. In business, we see this in DeepSeek's approach to AI. While American companies built massive data centers and poured billions into brute force compute, DeepSeek asked, what if there's a smarter way? They didn't try to outmuscle the incumbents. They flowed around them with a different strategy: efficiency over scale. They adapted to their constraints, limited access to cutting-edge chips, smaller budgets, and turned those constraints into advantages. In relationships and careers, flexibility means listening more than talking. It means asking, what does this situation require, rather than how can I impose my will? It means being willing to change your mind when new evidence emerges. But here's the crucial point. Flexibility alone isn't enough. Water doesn't just flow around obstacles and give up. It keeps flowing, which brings us to the second quality. Persistence, the compound effect of time. Water doesn't carve through rock in a day. It doesn't carve through rock in a year. It carves through rock over centuries and millennia, one drop at a time. Each individual drop does nothing, but millions of drops flowing in the same direction, over enough time, become unstoppable. This is the second lesson. Small, consistent actions compound into transformative results. We live in a culture obsessed with overnight success, viral moments, and 10x returns. We celebrate the entrepreneur who builds a billion-dollar company in 3 years and ignore the one who builds a sustainable business over 20. We chase moonshot investments and dismiss the power of compounding modest returns over decades. But nature doesn't work that way. Nature works like water, slow, steady, relentless. In your career, persistence means showing up every day, learning a little more, building a little more, connecting a little more. It means playing the long game when everyone around you is playing the short game. It means understanding that expertise isn't built in a weekend boot camp. It's built over years of deliberate practice. In investing, persistence means staying disciplined when markets get volatile. It means dollar cost averaging into quality assets rather than timing the perfect entry. It means ignoring the noise and focusing on the fundamentals. Warren Buffett didn't become one of the richest people in the world by making flashy trades. He became rich by finding good businesses and holding them for decades. Water, not fire. In personal development, persistence means committing to habits that won't pay off today or tomorrow, but will transform your life over time. Reading for 30 minutes every day won't make you smarter this week, but do it for 5 years and you'll have consumed knowledge that most people never will. Exercise for 30 minutes every day won't give you visible results this month, but do it for a year and your health, energy, and confidence will be unrecognizable. Flexibility plus persistence, the unbeatable combination. What makes water truly powerful is that it combines both qualities. It's not just flexible, it's persistently flexible. It's not just persistent, it's flexibly persistent. It adapts to every obstacle while never stopping, never giving up, never losing momentum. This is the strategic insight. You can be flexible in your methods while being persistent in your goals. Let's bring this back to the real world. You want to build wealth. That's your goal. Persistent, unchanging. But how you build wealth must be flexible. If stocks are overvalued, you look at bonds. If bonds are unattractive, you look at real estate. If public markets are volatile, you build private businesses. The goal stays constant. You want to build a career. That's your goal. But the industry you work in, the skills you develop, the companies you join, those must be flexible. The world changes. Technologies become obsolete. Companies rise and fall. If you're rigidly committed to a single path, you'll break when the environment shifts. But if you're flexible in your approach while persistent in your ambition, you'll flow around every obstacle. You want to maintain relationships. That's your goal. But how you maintain them must adapt to circumstances. Sometimes a relationship needs space. Sometimes it needs intense focus. Sometimes it needs conflict and hard conversations. Sometimes it needs silence and understanding. Rigid rules destroy relationships. Flexible persistence sustains them. The modern application. So how do you apply this ancient wisdom in February 2026 in a world of AI disruption, crypto volatility, and economic uncertainty? First, cultivate flexibility in your thinking. When the facts change, change your mind. When a strategy stops working, try a different strategy. When an assumption proves false, update your assumptions. Don't cling to beliefs out of ego or stubbornness. Flow around obstacles rather than trying to smash through them. Second, cultivate persistence in your actions. Show up every day. Do the work even when it's not exciting. Build habits that compound over time. Trust the process. Remember that transformation happens slowly, then all at once. Third, remember that the loudest, most dramatic actions are rarely the most effective. Water doesn't roar. It doesn't announce itself. It doesn't try to impress anyone. It just flows, and over time, it shapes the world. In markets, this means ignoring the noise and focusing on fundamentals. It means making small, consistent investments rather than swinging for the fences. It means being patient when everyone else is panicking and cautious when everyone else is euphoric. In life, this means focusing on daily habits rather than grand resolutions. It means valuing consistency over intensity. It means understanding that the person you become is the sum of what you do every single day, not what you do once in a moment of inspiration. The final thought. Lao Tzu understood something that modern culture often forgets. True power isn't loud. It isn't forceful. It isn't about domination or brute strength. True power is the ability to persist without rigidity, to adapt without losing direction, to flow without losing momentum. Be like water, not because water is weak, but because water is unstoppable. When you face obstacles today, and you will, don't try to smash through them. Flow around them. When you face setbacks, and you will, don't give up. Keep flowing. When you face uncertainty, and we all are, don't freeze. Adapt. The rock looks strong, but it's brittle. The water looks weak, but it's eternal. Over time, we know which one wins. That's all for today's Morning Digest. Thank you for spending part of your Saturday with me. Stay informed, stay flexible, stay persistent, and I'll see you back here tomorrow morning with another round of markets, crypto, tech, and wisdom to start your day. This is your daily morning podcast, signing off. Make today count.